186 banks could fail. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, an alarming report shows that more than 180 banks now face the exact same risk that Silicon Valley Bank faced. And if deposit runs continue, they could all face failures. And we're going to dig into this report to further deepen your understanding of how the banking system works and why this problem is not localized just to Silicon Valley Bank, why it's targeting small and mid-sized banks and not the big mega banks. Plus, we're going to look at the set of circumstances that would need to happen in order for all of these banks to face insolvency. And what you're going to be surprised about is it won't take much. Plus, we have some shocking news out of the consumer that tells us the economy is in far worse shape than we thought. Now, let's head over and we take a look at this report, and it's titled Monetary Tightening and the U.S. Bank Fragility in 2023, Mark-to-Market Losses and Uninsured Depositor Runs. And of course, this is dangerous news because, again, this report came out this week in the aftermath of what's going on with Silicon Valley Bank. And it's stunning to think that we could see potentially 186 more banks fail. It would be devastating to the financial system and the U.S. economy. Let's dig in to see what they're making their claims and just how close this is to happening. When central banks tighten monetary policy, it can have significant negative impacts on the value of long-term assets, including government bonds and mortgages. This can create losses for banks. Now, I want to stop here for a moment and say that this actually happens. It happens throughout history, and normally it's not a big deal, but today it's a major issue. So let's continue on, which engage in maturity transformation. So this is something I really want you to understand is they finance long maturity assets with short-term liabilities or deposits. So as you think about this, when you deposit money into a bank, you can take it out the very next day. In many cases, you could take it out the same day. It's not really an issue. But banks, however, they don't back these deposits with overnight maturity assets because the data says, history says, and everything tells us that the typical retail deposit will stay at a bank on average for somewhere around 5 years. So what a bank does is it goes out and it buys interest-bearing assets or it originates loans with an average maturity and it builds out its portfolio and guess of the time frame. You got it, around 5 years. But what the problem then becomes is if all these deposits leave, well, now you're stuck with a portfolio about 5 years in duration and no assets to back it. One of the challenges is interest rates rise, the value of a bank's asset can decline, which we're seeing right now, and record decline, potentially leading to bank failure through two broad related channels. Uninsured depositors now represent a significant source of funding for commercial banks. This is extremely true, accounting for about $9 trillion in liabilities. Liabilities meaning your deposit being a liability to the bank, which can make runs a significant risk for these institutions. In fact, during the 1980s and 90s, nearly 1/3 of savings and loans institutions failed due to losses incurred from long-term fixed-rate mortgages that declined in value when interest rates surge. So what we see looking back in history is a savings and loan crisis, for example, was a similar situation where interest rates went up, depositors were chasing higher rates, and banks were stuck with long-term assets that had declined in value. Next thing you know, you have a banking crisis, banks go insolvent, and the whole thing starts to blow up. And yet here we see it today. But as we talked about in prior shows, one of the challenges is these banks are stuck with these portfolios that they built out during a low interest rate environment, which is exactly what they should have done. Now, if you want to know more details to the mechanics of why this is a problem today, head over this weekend to my friend Jeff Snyder's channel titled Eurodollar University, and we get even deeper into the mechanics of why this is okay for banks to hold losses, and the system is actually designed to deal with it. But today it's not working at all, and one of the challenges is the Fed is in direct competition. And as I pointed out on a prior show, the Fed is sitting on $2.1 trillion of overnight reverse repurchase agreements. These are backing federally insured money market accounts, which now appear to be federally insured, as they are now, we're seeing again, money market accounts sitting at the Fed. And we're going to see, and we talked about this in the show the other day, as certain money market funds were being shifted to government-backed money market funds, kind of en masse. Why is that? Well, one's backed by the Fed, the other's backed by the banking system, and sure enough, one of the challenges these banks are facing with these low maturity portfolios that are sitting with an average duration of 5 years is right here. If you look at effective February 2nd, we talked about this recently, the Federal Open Market Committee directs the desk to conduct overnight reverse repurchase agreement operations at an offering rate of 4.55%. Now you take a haircut off there for the money market fund to manage it, and you still have a rate that's significantly higher than what the small, medium, regional banks and everyone else at that level can pay. And so depositors are going to look and say, why should I keep earning 0.0 some odd percent when I can just shift my money over to a money market account? And now I can shift it to effectively a federally insured, although we know it's not actually federally insured, it's federally backed. We'll use a more proper term for this, at a significantly higher rate, setting up the case of why we're likely to see further deposit runs. The Federal Reserve Bank responded to high inflation by increasing interest rates, which resulted in a substantial decline in the market value of long-term assets. This is true. Between March 7th, 2022 and March 6, 2023, the federal funds rate rose sharply from 0.08% to 4.57%, and this increase was accompanied by quantitative tightening. Now, I'm going to challenge the second part of that quantitative tightening, but here we can see, looking at 5-year Treasury security yields against the federal funds rate, that shown in blue. And what we can notice throughout most of history, we see that the bond market yields rise ahead of the federal funds rate. We can see that pretty clearly. Now we could also make the case that as the Fed continues to raise rates, the bond market actually begins to price that in and believe it and drive rates higher. So we can say that yes, there is some direct correlation here. The Fed said they'd eventually raise rates. The bond market responded, rates went up, and now the bond market saying, we think you're about to cut. But this notion that quantitative tightening actually has any effect is literally preposterous. Here we have the monetary base where we see the effects of the Fed's balance sheet from its open market operations such as QE and QT show up. And what we can notice here, the monetary base is in blue, and you can see it has virtually no relationship to 5-year Treasury yields. Now we could argue here perhaps in late 1990s that when the Fed increased its balance sheet, for some strange reason, interest rates rose, and when they decreased their balance sheet, rates fell. Now that's not what the normal belief is, because here you can see during the QE1, the Fed's balance sheet went way up and rates went down. But even looking at the two lines, you can very clearly see there's not a whole lot of relationship here, because there's another case here around 2013 or so. The Fed year-over-year rate of change and balance sheet increased and rates went up, which is again contrary to what popular belief is, and not just popular belief, what the Fed says is how it should work. So we'll just say the second part of this isn't that true, but the first part definitely has a relationship worth looking at. We illustrate that uninsured leverage, i.e. uninsured debt to assets, is the key to understanding whether these losses would lead to some banks in the U.S. becoming insolvent. Unlike insured depositors, uninsured depositors stand to lose part of their deposits if the bank fails, potentially giving them an incentive to run, which is exactly what started to happen. Now, the question, of course, we could say is, did depositors really believe that they would lose their money, or was it the fear that as the economy slows down, they would lose access to their money? Now, remember, we've covered on this show in the past that savings rates are extremely low, so obviously this is a potential case now where it wasn't the belief that they would lose their money, but they had believed that they would lose access to their money, and this is why we saw the White House respond just as we would expect policymakers to do. And here we see from March 13 remarks by President Biden on maintaining a resilient banking system and protecting our historic economic recovery. And he said, quote, "Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them." Now, I'd ask for your opinion on this, but I kind of have a general idea from the comments I've been reading. But just if you didn't get the idea that the government was wanting you to believe in some way or Marinello that they were covering every deposit at every bank in the U.S. He went on to say not only a second time, but a third time, he said, look, the bottom line is this: the Americans can rest assured that our banking system is safe, your deposits are safe. And then what did we find out later on from Janet Yellen? That perhaps not all of your deposits are safe, and that perhaps there may not be an implicit actual insurance by the government on every deposit after all, which of course, as we know, will lead to likely more people reevaluating where their money's at and potentially moving it, which is where the problems will only magnify in this situation. A case study of the recently failed Silicon Valley Bank is illustrative. 10% of banks have larger unrecognized losses than those at SVB, wow, which is a staggering number, nor was SVB the worst capitalized bank. Of course, now you put this in perspective and you start to think, wow, this system's got a lot of problems, with 10% of banks having lower capitalization than SVB. On the other hand, though, this is what everyone's fixated on right now, is SVB had a disproportional share of uninsured funding. Only 1% of banks had higher uninsured leverage. Combined with losses and uninsured leverage provide incentives for an SVB uninsured depositor run. Of course, the question then becomes, is this just an issue of the fact that they had this higher than unusual uninsured leverage, or is it something else? Let's continue on. Even only if half of uninsured depositors. So now we're going to get into what the case would have to be to see a further collapse in the banking system. So again, if only half of uninsured depositors decide to withdraw, almost 190 banks are at risk of impairment to insured depositors, with potentially $300 billion of insured deposits at risk. If uninsured deposit withdrawals cause even a small fire sale, this by the banks, substantially more banks are at risk, and overall these calculations suggest that recent declines in bank asset values very significantly increase the fragility of the U.S. banking system to uninsured depositor runs. Now, if you don't think all this news is causing people to reevaluate where some or all of their money is being held, then you've got it wrong. People are going to spend the weekend, this next week, they're going to watch the news, they're going to be worried, and they're going to make a decision to start to move some of their money. And $300 billion, when you look back now at the Fed's backstop of money markets, seeing a $2.1 trillion, $300 billion isn't a big number here, and that could lead to an all-out collapse of potentially 186 banks. And you can only imagine if 186 banks start to go down, you bet a whole lot more. And now this turns into what we're seeing with the consumer is a complete lack of confidence. But what is shocking here, this is starting before the news of Silicon Valley Bank broke. Here we can see from the University of Michigan their preliminary results for their consumer confidence survey. We know consumer sentiment now tumbling down back in March from in a minus 4%, 5.4% month over month change. Current economic conditions slumping as well. Index of expectations, this is future, is back down to 61.5. We can see in their chart here, this is terrible. This is outright ugly. Now let's look into some more details here as consumer sentiment fell for the first time in 4 months, sitting about 5% below February, but remains 7% above a year ago. And this month's decrease, get this, was already fully realized prior to the failure of Silicon Valley Bank, making all of us wonder how much worse this can get. And for the market, though, yeah, this is a big warning sign. Here we see consumer sentiment. This is not the preliminary data because it is not posted to the Federal Reserve website. Against the Wilshire 5000 showed that on a year-over-year rate of change in red. So further declines in sentiment could likely lead to further declines in stock prices. How about inflation expectations? Well, they receded because there's nothing more deflationary than a banking crisis. And what do we see in relation to the bond market? Of course, we see here that indeed what we note is there is a relationship between the two, and that suggests that interest rates here are likely to come down. But we note that, of course, inflation expectations are a function of gas prices, and as gas prices remain weak and head lower, which is quite common during a recession, that of course inflation expectations are also going to head down. And that means, of course, perhaps some hope for the banks if the Fed can lower rates and rates come back down, that will help reverse some of those unrealized losses. But the question is, will depositors flee before that? And if they do, look out, more banks are coming down. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.